These are 5 harsh money rules that I wish I had known in my 30s, my 40s, and my 50s. And I hope by sharing them with you, you can benefit from them. I've been a financial advisor for over 20 years, and so I've learned a lot both from my own experience as well as the experience of my clients. And the first one is, it's just shocking how few people save anything. So it's not enough to just earn a nice salary. You also have to save money. Over half of all Americans earning $100,000 a year or more don't save a dime. So if you're in a situation where you're not saving anything, but you're making enough money that you know you probably should be saving something, super important that the sooner that you can change that habit and start saving money, the sooner your money that you save can start working hard for you. Otherwise, we're just going through life and we're not saving anything for our future self to have a comfortable retirement. And there is a day of reckoning coming. And unfortunately, and at least in the American society, there's almost an unlimited amount of debt available to us. So we can play this game for a long, long time and live above our means. But you know when that game ends? That game ends when you quit working and you no longer qualify for more debts. And so you're going to be, if we don't start saving, you'll become a prisoner to your debt and you'll never be able to retire. I really don't want that to happen to you. The second item is it's not enough to just save. We also have to invest. Too many people save money and think it's going to be okay. And if you save $10,000 a year, which is a nice sum, and you don't invest it, at the end of 7 years, you're going to have about $70,000. But if you can invest that and it over a 10-year period, average a 7% per year return, you're going to have $100,000. And then about 25 years later, you're going to be really close to $1 million versus having $250,000. And the sooner you start thinking about investing, the sooner you can get your money working hard for you. It's almost like if you were a king and you had access to an army, but you never sent the army out to protect, to help the country become stronger. If you never did that, then what's the sense of having those soldiers? And your dollar bills, each of those dollar bills is like your soldier. And I want you to put them out there and have them make money for you, which brings me to number 3. Point number 3 is there's no shortcuts. People look at some investments that have doubled in the last year, or, some of the cyber currencies have done really well. And people think, oh, if only I had put $50,000 in this coin or that coin, I'd have $500,000 because it went up by 10x. Maybe, or maybe not. For every one of those stories that works, there's a lot of the stories that don't work. And so at least for me, the slow and steady, the tried and true, you want to have a high likelihood of success over a 10-year period versus a small likelihood of hitting the ball out of the park in 12 months. Because more often than not, we don't hit the ball out of the park. I wish we did, but it's time in the market. It's not timing the market, which brings me to item number 4. What does determine our success as an investor? I should mention, I'm here in Costa Rica, which is why it looks like there's a jungle behind me. I'm on vacation and ocean's in front of me. So let's go for a little bit of a walk as we talk about what does determine your success as an investor. We're fortunate. A lot of folks would say, well, nobody knows, what makes Warren Buffett and somebody else not. Well, there's a lot of money to be made in this. So there's been multiple studies that have been shown. And actually, the success of an investor is 80-90% determined by your asset allocation. What percent of your portfolio is invested in stocks and what percent's in buys? That's going to determine 80-90% of your success. There's been multiple studies that have shown this. And people think, well, I've got to be good at picking companies. I've got to be good at picking stocks. No, you need to make a good decision that's consistent with what your goals are, what your constraints are, what your risk tolerance is, and come up with an asset allocation that you can stick with in good times and in bad times. Because again, it's not timing the market, but being able to stay the course over a period of time in the market. So how do you figure out what your asset allocation is? I'd say that there's two things. The first one is this is a really, really important decision. And so hiring a professional to help you think through it, I think is key. You don't need to necessarily sign up for a 10-year relationship and pay them 1% of your assets for the rest of your life. But hiring a professional that's helped guide other people that know what possible that you might not be thinking about is key. Let me give you a for instance. People think as they get older that, their risk tolerance goes down. And, in theory, it doesn't have to. When you enter retirement, most of us are still going to have a 20, 30 plus year time horizon. I do think that our risk tolerance goes down, but not because we have less time, but because we always want to avoid being a forced seller in a down market. And people generally become forced sellers in a down market because of three reasons. One is if they have debt that comes due and they don't have a choice. The debt comes due, it's either declare bankruptcy or sell some of your stocks, sell some of your assets to pay down your debt. So that's one that I've seen. The next one is when people enter retirement, they need the money in order to pay for their living expenses. So they don't have a choice. They have to sell the money or the stocks in order to sell for their living expenses. But the third one, which is the most common, is the pain of loss increases dramatically. The pain of a 20% loss in the stock market, 30%, 40%. And these types of corrections happen in the stock market. It's not a bug, it's a feature of the stock market. And those types of losses become much more painful once we no longer have new money coming in from our job in the form of a paycheck that we can invest when prices are lower, right? When the stock market corrects and you're getting your paycheck in every month, well, you get to invest at those lower prices. But when you no longer have new money coming in, you really don't benefit. So investing that new money in is called dollar cost averaging. But the evil twin of dollar cost averaging is what retirees face. And that sequence of return risk where you take money out during that period and you're a forced seller, either because, as I said, the mental pain or because you need the living expenses. So how do you protect yourself from that? You protect yourself with the asset allocation, but let me share with you a secret. Instead of thinking, my portfolio is 60% stocks, 40% bonds, 50% stocks, 50% bonds, whatever it is, I want you thinking about the bond piece of it. And by bonds, I want you to have or to think about and consider having high quality bonds that are going to mature in 2, 3, 4 years, what I call short duration bonds that are unlikely to be impacted significantly as long as you know you're going to get that money paid back by the corporation. And as long as that money is going to get paid back soon, if interest rates go up, the value of that bond should not be affected as much as a longer term bond. Long story short is I want you to think about your bonds, not as a percent of your portfolio, but how many years can you live off of those bonds without having to touch your stocks? And hopefully that'll give you some solace in scary nights. But it's just human nature. If let's say you have 500,000 in the stock market and 500,000 in bonds. If the stock market drops 20%, that's $100,000. And that's still going to feel very painful. You're going to remind yourself, how long did it take me to save my first $100,000? And for many of us, that was 7, 8, 10 years or more. And to have that wiped out in 10 trading days, 20 trading days, in 6 months, whatever it is painful. So making good decisions is critically important. And I hope you consider watching this video here. YouTube thinks it's a perfect match for you. I encourage you to watch it. I'll see you in it. Bye bye.